We are live.
We are live.
We are live with some guests with us today. But welcome back to the Your Everyday Rich podcast with Jason and Jenn. If it's your first time, thank you for finding us. And I'm not sure how the hell you found us, but I appreciate it. If you're back again, well, thank you for coming back and bearing with us again. It's awesome. We have a pretty good episode today. I think this is going to be pretty good. We actually are bringing on guests now and essentially having conversations or living room conversations with them to hear their living room conversations. So today we have Jonathan Wong and Stephanie Yu, who we met through our real estate investing circle. Mm-hmm. And then eventually, became friends. And then we've networked quite a bit, and we've kind of seen their journey and where they are and how it's aligned with a lot of people our age, although they are much younger than us. So they will bring an interesting perspective today on their relationship with money and how that's kind of evolved from their childhood to now and what they're working on to, build their everyday rich lives. So
I'm excited for this conversation.
Yeah. But before we get started, I want to say shout out to our sponsor, Plantwell Inc. If you're in Milton, Ontario, go reach out to Plantwell Inc. They are the go-to place and resource for hydroponics and growing vegetables and all this other stuff. So Google them. Okay, good friends of ours. So, but without further ado, welcome, Jonathan and Stephanie.
Thank you.
What's up, guys?
Where's the applause?
We'll add that.
I'll put that in.
We'll add it when I
edit. Yeah. So, Jon, thanks, and Steph, thanks for joining us today. I guess before to get kind of the audience to know you, why don't you tell us about yourselves, right? And tie that back to kind of go back to a time in your childhood and how you viewed money back in the day. But tell us about yourself first.
Yeah, sure. Steph, you want to go? Or
no, you can go first.
Okay, I'll go first. First off, congrats to you guys. We want to congratulate you guys for starting this, right? So it's pretty cool, inspiring to see you guys start this. It's not an easy thing, right? So to see you two do this, similar age group too, right? So it's cool to see. So thank you for that. So Steph and I are both CPAs. We're both CPAs. We met in Ryerson or Toronto Metropolitan University. We did, the typical Asian upbringing, right? You either be a doctor or engineer, a lawyer, or an accountant, whatever, right? But so I've always been interested in business. So I just wasn't sure where I wanted to go. So once I took an accounting course, I figured, this is the language of business, right? So if you understand the language of business, you're able to, articulate it, speak it, understand, and so forth, and analyze the business. It might, help you further down the line, and which it has, right? So, doing that, and then I guess I started working I did my CPA. Did my CPA. I've been working at the corporate life as an accountant. I do more of the financial planning and analysis side, less of the more tax and controller side. But that's a little background on myself, and maybe I'll go to Steph on where your background was.
Yeah. Also, I'm a CPA. Just need to do my experience. Met Jon at Ryerson. I actually studied law and business and finance.
Yeah.
So after being in a law firm, I realized doing the legal work, doing the paperwork wasn't for me. So I switched over to accounting. So unlike Jon, I actually do controller, the audit, tax, and a little bit of FP&A as well. Yeah. Oh, that's a little bit.
Cool. I guess some context here. So Jon and Steph are married. And Jon was mentioning the immigrant upbringing. So I guess, Jon, are you Chinese? Would you say, yeah, Chinese, right?
Yeah,
Yeah,
would say
yeah.
so. Yeah, like my family was from the Philippines, but we're Chinese. So
Oh, okay.
they immigrated here in probably around 70s, 80s, around there. So yeah, how about you? And Steph,
Steph, right?
Same.
Yeah.
Same. My parents and grandparents are from Hong Kong, and came and immigrated in Canada.
Yeah.
So you guys both born here? Born in Canada?
Yeah.
Yep.
Yeah.
Oh,
Yeah.
okay.
Okay, yeah. So like first generation, kind of like us, right? So like a lot of, I guess, our friends, people that we know, parents coming as baby boomers overseas, past the war and everything, and then I guess coming to Canada or the States and landing here somehow.
Yeah.
Yeah. All right, cool.
So were your parents born here as well, or were they born in another country and then immigrated here?
Yeah, my parents were born in the Philippines. Steph's parents
Were born in Hong Kong. And
Oh, okay.
Yeah, and they came here.
Yeah.
Oh, okay, cool. So then, interesting. So then, if you can kind of go back to your childhood, right? Like speaking of parents, because I think our parents influence us so much on like a lot of things, especially money.
Well, yeah, your upbringing is probably one of the most biggest factors of how you view money, I think.
Yeah.
Right.
Yeah. And would you say kind of like, well, how did your parents influence your views on money earlier on? Like, did you actually see that as something that was very like noticeable growing up, when like the conversation about money and stuff like that?
Yeah, from my childhood, it was really noticeable. I would say it wasn't that much of a taboo at my house to talk about money. My parents were very strict about saving. When you work, save X amount of your paycheck for a rainy day. So it, like, we talked about it a lot. And also, I think, growing up, because actually my dad's a real estate agent.
Oh, yeah.
So growing up, I've been into like seeing his investments, what he was selling. So
Okay.
it was
Okay.
like a daily thing to me just to see that. And obviously, with that being said, with a conversation of money, the investment part came up as well. So it's a very, like, growing up, very open kind of line of communication with money and investments.
Yeah,
Interesting.
My house was a bit different, I guess. Coming from, it's very typical immigrant upbringing. I think, like, you're coming in with you not having, similar to what you guys were saying in your earlier episode, was you're coming with not much. You're new. I think the big thing is being new to the country and not having that connection and that network is huge. And there's a lot of uncertainty, right? So
No, that's cool. Like, thanks for sharing, because it's interesting to see that different dynamic, right? Where, Steph, you have I would say a very non-typical upbringing in terms of like what we observed with myself and obviously your and our friends, and versus Jon, like something kind of more similar to what we observed in our childhood. So it's kind of cool that actually being young, that you were exposed to kind of that investing side early on, versus where I think the big story that we hear, especially like you, Jon, what you're saying is that saving mentality, right? It's a bit of a scarcity thing. It's like, hey, work, save, and then not really talk about investing per se. So
exactly.
Yeah. Okay, cool. So then Steph, I'm gonna go with you. I'm gonna run with you a little bit, because yours is a bit different, right, than kind of what we've heard. So like, when you were saying your dad was a real estate agent and investing kind of it was more natural for you guys to talk about that.
Yeah.
So what did he invest in? Like, was it all real estate?
It was all real estate.
Okay.
It was all real estate because I think that's what he was comfortable with.
Yep.
And he's not a risky person. He's very risk averse. So because he's seen so many projects and inventory, he knows exactly what's, I guess, quote unquote, worth it, or will generate income at that market. So it was pure real estate when he invested.
And then did you get involved earlier on as kind of like in your childhood? Obviously you were exposed to it, but did he kind of like bring you along into his investment properties, or kind of run you through kind of what he was doing?
Yeah, he definitely did bring me on to, his work site, the investment properties, seeing the blueprints, reading blueprints, and what it actually means when you're actually paying it. That value on the listing price is actually the future value, not the present value. So he brought me through all of that and explaining explaining it. And also, it's not just the investment part, like all the min paperwork, the legal docs, what it actually means. So he actually went through that with me when I was younger. And obviously, when I was younger, you don't really appreciate it. You're like, okay, cool, dad, this is your job.
Yeah.
Yeah, all right, cool. What does this have to do with me? And but yeah, definitely he brought me through every single step of the way when he was doing it.
And was that what type of like real estate investments did your dad get into?
He did condos.
Okay,
He
condos.
actually did downtown Toronto by the Harbourfront, which actually we still have, and where Scarborough's town center is.
Oh wow, yeah. So if we can just go back in time and think about what Harbourfront and that downtown Lakeshore corridor looked like, it's nothing to what it's been right now. Like the last 10 years has been this crazy condo boom. So it's amazing to see kind of that foresight. Obviously, like your dad took some risk and was in that industry, but it's like to have someone, I think, as a parent see that earlier on is pretty amazing. All right. So Jon, like we met through our real estate network. So before that, did you have any exposure to investing prior to like real estate or even prior to Steph?
Yeah, that's a good question. I think for me, like, so no, like my family was, it was very, back then, I'm not gonna repeat it. Yeah, very typical, like work hard at your corporate job, right? Get as much pension. That was the one thing probably my parents told me was just work at a good corporate job, get that pension, all that benefits and stuff like that. But for me, I was always interested in this stuff. I think it was kind of just self-taught. I don't know what it was. It was just the math. Like, I don't know. I just had I just started reading into, like what the markets were doing at the time. And I really started investing in stocks and stuff like that and personal finance back in like 2012, 2013. Once I started, saving up from my corporate job, right? Always the question was, where do I put this? Maybe that kind of like ignited the curiosity. So I knew like putting into a checking account didn't make sense. Yeah. Right. So.
Okay. So you mentioned.
Did Steph influence you into real estate investing just because of her background or family?
Not really. I've always was interested in it. I always understood the concept of it. Like you buy property, tenant, you get the cash flow, mortgage pay down, stuff like that. So I think it's from all the research I've done early on in my, after starting your corporate career, right? So
yeah. Okay, so you mentioned stock market. What do you remember? What was like the first stock you ever purchased?
Good question. Shoot, I think, man, Hershey. I don't know what it was. Hershey was one of the
confectionery company.
Like chocolate?
Yeah, we're crazy. No one talks about it. Hershey, HSY.
Oh, wow.
I'm surprised it's not Apple.
Apple at the time, back in 2012, 2013, was it was more volatile. I liked Hershey because it had a good dividend at the time, and I tried trading it and like day trading it at the time.
Yeah.
But it's a different, you play around, right?
Yeah. Okay.
Yeah.
So then did you start out with individual stocks or did you go into indexes or anything like that? Because I think ETFs were starting to come about around that period.
2013? Really?
Yeah.
I don't remember when
it was starting. Yeah, it was mainly individual at first. And then once Wealthsimple came out, probably 2014, the robo-advising stuff came out. That's when I really started using that. Okay.
And then, so prior to all this, did you ever go into like, let's say the banks? Because I think at some point, everyone has their money in a bank, right? As much as everyone says, like, don't keep your money in the bank, your money goes somewhere first, and then you can distribute it. Did you ever sit down with one of those advisors at the bank?
Yeah. Oh, yeah.
Okay.
Yeah, for sure. Like when we got our mortgage, I don't know. You know me, Jack. I always try to get the best deal. Just there's that like, I don't know. It's like a game. You're trying to get the best. And I remember we had our HELOC with our current mortgage, and I wanted a lower rate or whatever. And they're like, yeah, we'll give you that if you, talk to one of our advisors, if you, see if you can bring more business to them. Right. So, they definitely pitch, of course, certain products that are benefiting them, but there's nothing wrong with it. I think it makes sense for some people, but it didn't work for us.
Okay. So then, so it's interesting. So I'm kind of painting this picture for everyone, right? Where, Steph, you brought that real estate side. Jon, you kind of had that exposure to the stock market. And then as you got to get like, obviously you met each other in school, and now where you are now in your journey. Did you see any changes? Have you observed any, I guess, mindset shifts from how you invest or the fundamentals of how you like what you believe in investing from back in the day till now?
Steph?
Yeah, I actually never did any like investing in stocks ever, ever until I met Jon.
Okay.
Jon is like, what are you doing with your money? We need. I think at that point in that time frame where we were having this conversation is we were getting married, we were looking for a place. So I had extra reserves, right? So
Yep.
Jon was just okay, you're very passive. Let's just put everything in Wealthsimple. That would help you and help us. So for me, that's my shift and my change for investing in stocks.
Were you hesitant on going into the stock market before, Steph?
I was hesitant just because I didn't know what I was doing.
Okay.
There's not enough information. I feel like, yeah, I definitely did finance, understood like the calculations and everything. But when you sit in a lecture hall and doing it in real life, it's completely different and it's mind blowing.
Isn't this crazy? She has a BCom education, but didn't know what stocks were. Isn't that kind of crazy?
And I studied finance.
They don't teach you this stuff in school.
Yeah,
it is just like, what's a delta? What's an alpha? What's a beta in school, right? But in real life, they don't do practical examples. They don't blow up like the Wealthsimple platform or what have you not back then to pick stocks. So I
Interesting. Okay, so would you say from an emotional standpoint, have you when you kind of got into the stock investing with Jon, what were your emotions? Like, what did you feel in terms of like, I guess, committing to saying, okay, let's go and, put some money into the stock market? Because you obviously have that real estate exposure. So you're comfortable with that. But stocks are like a totally different thing, right? And we hear a lot of people talk about the stock market being risky and you can lose your money, look at all the crashes. But so obviously, with the charm of Jon convincing you, what was that feeling? Like, can you describe that emotion kind of, because you're putting money away somewhere that you're not familiar with?
I think at that time when I did it, I trusted Jon's perspective. And, I understand how the market would go up and down just like real estate. And when you're putting something down, it's definitely for the long run, the long term, again, just like real estate. Yeah. So I wasn't hesitant too much at that time because if I knew someone so close to me doing it and he's doing fine, I might as well, I'll be okay as well.
Yeah.
So because I was so passive, I don't check it every day.
Yeah.
Like I was okay with it.
And I think that's a key thing that you mentioned, Steph, like checking your portfolio every day. That's a thing that can get very emotional, frustrating, especially if, it doesn't matter what you have in there, but every time you see a red show up on your whatever app you're using or your portfolio, like red, elicit this feeling of fear.
Yeah.
It's like, oh my God, I lost whatever. But really nothing's happened to your portfolio.
No, 100%.
If you look at the grand scheme of things.
Yep. I agree with you.
So did you check your portfolio every day?
Oh, me? No.
Yeah. Oh, okay.
I definitely did like once every 2 weeks, once every month. He'll ask and I'm like, I don't know. Here's my phone. You can check if you want, but we'll be fine in like a month.
No, I'm kidding. I would ask to make sure if things are okay. But
okay, cool. So then, Jon, you obviously have a bigger exposure to stock market before. You mentioned in terms of like having a passive approach to the stock market. What would you say your approach to the stock market is from an investor standpoint?
Yeah, no, good question. I think I've gone through all the BS, right? You try to play fast money a lot, right? You do, and I think I may have mentioned it to you before privately, like the whole fast money trading and stuff like that wasn't my skill set. It's not something it's acknowledging at first what you're okay with, right? And I'm actually a bit risk averse too, right? So to answer the question, I think I would say index funds is like as the Warren Buffett approach, right? Didn't I think he said at one point when he passes away, he wants all this stuff to go to a S&P 500, right?
Yeah.
Like,
Yeah.
because he'll never know what the next big company is going to be on the top, right? In the next 10 years. So I think that's the best. Just stick to simple index funds from a stock perspective.
Yeah, no, I agree. I think majority of people should have, this is not investing advice, but from a broad exposure to the market, just sticking it in an index fund is really easy. Like that's the key thing, right? Like you're mentioning chasing fast money. We're in a society where everyone is looking for instant gratification, but instant returns. Like we are looking for the diamond hands, the rockets,
Yeah.
right? Whatever meme, the Wall Street bets.
Yeah.
But we forget like the basic principles of investing is like simple and stupid works, right?
Yeah, like I'm your typical couch potato investor.
Yeah, that's what it is. Yeah, there's a website called Couch Potato.
Yeah, that's seriously exactly what I am. I'm so boring. Like, and I don't even check every 2 weeks. I check it like every couple months.
Well,
and that's the way it should be.
Yeah.
And, I agree.
So it's funny actually the other day because we kind of balance. We look at our portfolios every few months, right? Especially around tax season. It's kind of like you're downloading all the documents. I pulled something in one of my other portfolios that I started long time ago, and I looked at it. And I was just like, "Holy crap! I haven't touched this for years, right?" And I showed Jen. It was basically it's averaged the return of the typical stock market over the last
like 8 to 10% or whatever, right?
Yeah, it was like 17 years, 18 years, or even more in that account. Wow. And it's not anything. I literally never check it, but it goes to show kind of that power of compounding over time. You just don't look at it, you don't care. So what? Yeah. I think a lot of the time we've been sucked into this like, oh, you need to be able to make better returns than the stock market. Like you should be able to outperform as a regular person.
Oh man, yeah.
Right?
Outperform 10 or 8 to 10%. Yeah.
Outperform 8 to 10%. And then when we try to do that, most of the times people don't. That's just the statistics, right?
Yeah. So to touch on that bit of it, like early on, back like 2013 when I first started, I was like, oh yeah, this is great. You're gonna start seeing your wins, right?
Yep.
And then you see the losses, and then you come to this realization, like, crap, you know what? I'll never outperform. Like I'm lucky I came to that conclusion quickly. That you'll never be able to outperform the market as much as we all think we could, because we're not professionals, like what you said, right? Like we're not looking at it day to day.
Yeah. So I guess Jon and Steph. So what did you say? We talked on stocks. Like you guys are both exposed to stocks and real estate now, and you kind of have a best of both worlds. Now that you've kind of gone through that, and you still invest in both, correct?
Yeah.
Yep.
Yeah. Okay. So what do you like better? Or is there an argument for one over the other? And I'm going to let you kind of you tackle that.
Do you want to? Or I think, damn, that's well, yeah. As you know, Jay, I'm a bit of both. I don't have one bias towards I don't have a bias towards one or the other.
Yeah.
I think real estate gives you that the leverage piece on a good side, right? When you use leverage safely is good. Of course, but at the same time, what is good about real estate is that because you can't easily sell and buy, it does help on that emotional side, right? Like if you're pissed about it one day, like we all are sometimes about your real estate.
Yeah, whoever has variable rates is probably going through that.
And then from a stock perspective, you get actual some diversification and stuff like that. Is more liquid. So I think, and plus it's like they're actual businesses too, right? They have real processes and real moats behind those businesses, right? So both are good.
What's a moat? Can you describe what a moat is for our audience, just in case?
Yeah, sure. But in business school, it's kind of like your competitive advantage, right? What is it? It's like the Porter's 5 forces, right? It's like there's certain characteristics of a business. For example, Apple has a strong moat because of its brand. Even though it's like a cell phone, anyone can make a cell phone, right? But what stands behind Apple is they have their brand, they have their their economies of scale, their systems and stuff like that. They have
Completely integrated. Yeah.
Yeah,
Completely
exactly.
integrated. Yeah. I love Apple because of that too. Because like everything is connected, right? Their whole system is all interconnected, and it makes it very easy to use. So shout out to Apple. AAPL.
Sponsor, yeah.
AAPL. Yeah, Apple, if you're hearing, we could use a few new iPads. Okay, so cool. Like stocks, real estate. So just some context here. So Steph and Jon have been investing in stocks and real estate for the last 4 years. 4 years.
Yeah, 3 years. It was 2020. It was really
2020? Okay.
new babies.
Yeah, like we're babies too. We consider ourselves newbies in real estate.
Yep.
Like 4 years. So I mean, I think
what's our first downturn?
Yeah, what you're mentioning, Jon, about like a bull run, like we've been in a bull run for 12 years.
Yeah.
Right. Since 2008, 2009. So like no one has really experienced a significant downturn until now.
There was a little mini one in 2018.
Yeah, very small.
2018,
It was a blip.
right?
Yeah, it was a
mini
blip.
one.
It was
a
a
blip.
Yeah.
Definitely a blip.
It's like Trudeau slipped on something,
Yeah.
kind of like took his hand off something.
I remember that one too. It was like Christmas
Yeah.
Eve or something. I just remember it like so vividly. I don't know if you guys remember. Yeah, it was Christmas.
Yeah, no, we remember because our parents were selling their house. So the house I grew up in, like they were downsizing, and we're just like, yo, this is a perfect time. So they sold it kind of on that peak coming down from early fall. Yeah, late summer, early fall, and it was like just coming down. So
it was a start.
Yeah, we felt like it got out just in time, but then it just bounced right back up.
Yeah.
So, but
crazy.
That I mean, that's a sidebar, but like that's the power of real estate, right? Where like Jon, Steph, your parents have obviously owned their primary home and some real estate. Like our parents, like we only had our primary home, but my dad had a condo, so we had an investment condo. He actually might have had more. He just never told me. So
you don't talk about investing.
We don't talk about investing. Like you only find out by accident. Kind of like, why are we going to this dungy like condo? Like what are the pink walls? Pink carpet? Like what's going on? You're gonna vacuum this? You were going to steam wash the carpets? Like that was
use your kids for labor.
Yeah, every few years I would go to this condo and I'd be doing like cleaning carpets. What the hell's going on here? Like what am I cleaning carpets for? I had no idea, but eventually I figured it out. But where's I going with this? Like the power of real estate, right? Holding it over long term, is kind of like that key component of time. Where I think if you're starting investing and looking at that, it seems very daunting because like we want that return right away, right? It's like 7%. Oh man, 7% on $1,000 is only this much money. It's like it's tiny, but if you like take that, you compound it. You have real estate. You let tenants pay it off, and you obviously keep your expenses down, and you ride through some downturn and upturns. It pays itself off, right?
I think the hard part is because there's always so much like, if let's say you invested and you hit a downturn, the first thing you're going to feel is like, oh, I failed, right? We had a conversation with another real estate investor like a couple of weeks ago, and that person was like, I feel like I failed.
Yeah.
Like she was just really down on herself, right? And that's normal because anything you start, you hit the first or second blip, you're like, shit, I totally like bombed this. Like I shouldn't be doing this.
Especially if you're riding a bull market,
Yeah.
right? Where it almost feels like you can't get anything wrong, right? Like if anyone's listening and you got into the stock market, or maybe you didn't get into the stock market or real estate.
Yeah.
Like anyone that put any money into the stock market 2020 and early 2020, you couldn't get wrong.
You gotta be an idiot to lose money. No,
yeah. Like you had to, I guess, unless you invested into whatever Kramer did, Jim. Right. But like that's the thing, right? It really, from a fundamental standpoint, if you don't know why you're investing, but if fundamentally that investment is sound, over the long run, it's going to work itself out.
Yep.
But because we don't feel like we're winning right away, and our expectations are so short, they're so small. Like we have high expectations in such a short time frame that it's like, oh, 1 year, a couple months, it feels like, oh my god,
I think
I can't do this. Yeah.
Can't do this.
I think social media glamorizes it. I think that's a part of a big issue too, right? We see it all the time where you're seeing these quick home runs, and that was probably not realistic. That's not realistic, right? If you ask all the OGs from back in the day, like this was not normal, right? So
yeah.
Oh yeah, like even stock market, real estate, any
Or
type
yeah,
of
either.
commodity, it was just
Yeah.
like nothing. You could have traded corn and just made money. So yeah.
Exactly.
Yeah. I guess with that in mind, John, has your risk profile and how you analyze risk changed with what you've kind of gone through before and the last 3 years with your investing?
I think so. Yeah, a bit for sure. I'm not gonna lie. Now that going through this, recent rate hike cycle has
Yeah.
definitely changed my view, for sure, on my risk tolerance. When money was free for like 10, what was it? How long was it? Yeah, 08, right? Since money, who would ever thought that, right? But yeah, it's definitely changed a bit, and that's why it's so important to like study. You study history, you study the different asset classes. I think it's important to understand that versus, sticking to certain, stick to only just stocks or real estate, right? So
Yeah. Okay. Cool. So if you had $100,000, all right, free money or whatever the money is, Trudeau basically said, "Hey, we're giving you $100,000 refund. You don't have to owe it back." What would you put it into, and why?
Steph, what would you do? Let's ask Steph.
And I want to actually, before you get to that, so you answer that, but I want to understand the dynamic of how two young professionals, right, at your stage, how would you make that decision together?
Yeah, that's a good point. Where would I put it?
I think one of the factors that would like help us with the decision is where we want to go in the future, what our goal is.
Yeah.
With that being said, like, is it a 3-year time frame that we're going to use this money, like where we're going to go, and a 5-year time frame, and then maybe 10 and stretch it out. I think that's definitely one of the decision makers.
Yeah. I don't know. That's a good question, Jay. I never thought about that. Maybe I think number one is if you have any high interest debt, pay that down first. Like, for example, our HELOC is 7% right now. Like, we have a balance on that. I would pay that down first because that's guaranteed return, right? Like, where the hell are you going to get 7.2% guaranteed in the market right now? And then after that, then I'll probably start, building, like safer asset class, like bonds or whatever, and then stocks.
Sorry, John, what is that? What did you repeat that? Did you say bonds?
Yeah, I know. Yeah, it's crazy.
Bonds. Oh my goodness.
No one's invested in bonds for how long?
I know. I
Can
don't
you
think
please
anyone. I
provide
don't even think our parents. Yeah.
Yeah.
So can you please provide some rationalization behind your bonds comment?
Yeah, bonds are trading at what? Like they're giving you risk-free returns of. Well, now it's gone down recently. I think a couple months ago, it was almost giving you 5% for a 2-year bond, right? So risk-free. You hold it for 2 years, you get 5% the whole time.
Yeah, you bring a great point. I think the last few years has influenced a lot of investors to not examine the risk. So we're always looking at what's the ROI and upside versus the risk. So
because there was very little risk, or it seemed like there was very little risk.
The market allowed for you to take on that risk, right? Without worrying too much about that downside. So now that I think people have experienced that downside, and a lot of people have experienced it quite sharply, I think people's fundamentals of how you analyze an investment from a risk standpoint will come out first. And I hope that is the case, because when you look at Warren Buffett, like the greatest investors, they've taken on some, you would call it risk. Inherently, investing always has risks. Would you agree, Jon Steph? Like,
for sure, always.
Right. Yeah. So having an understanding of where that risk falls within your risk tolerance, right? Because there's no such thing as this is riskier. There's potentially more downside to that investment because of volatility.
At this point in time. Or maybe in the next couple years.
Correct. Yeah. So I think looking at that is really important going forward, because now then you can really gauge, okay, if I strip away all that upside about, like, assuming the market appreciates like crazy, like it did 2-3 years ago, well, what does that leave me with this investment? Right? Does it match your goal? Like, Steph, you're mentioning 3 years, 5 years, 10 years. So I think that's really key for people to look into. Yeah.
And
So
then by no means I'm saying like everyone should be doing that. That's just our risk. Our risk tolerance
Yeah.
is a lot lower. Like we're more risk averse, so
Mhm.
that's why
Yeah.
we go the safer step and then ladder up from there, right?
And there's nothing wrong with that. I find some comfort in some conservatism, like you're mentioning, because there's a point where how you invest, if you are finding it causes you to lose sleep, you're
Good
probably
point.
taking on a bit too much risk.
Yeah, that's a
I
good
agree.
point.
Yeah, because
Shoot.
then it affects your health.
Yeah, because you should never lose sleep over something. Obviously, like, we're gonna have that argument about like entrepreneurship is very risky, right? But society doesn't look at it as, oh, you're taking on too much risk because you're chasing your dream. But I can tell you how many entrepreneurs lose sleep over every night because their business might fail the next day.
Yeah.
Yeah.
It's the goddamn truth, right?
Mhm.
But you work a stable 9 to 5, I'm
Yeah.
going quote unquote for the audio. There's something to be said about like being able to rest easy, knowing that your 7% will be there tomorrow,
Mhm.
right? Yeah, you might not live that extravagant lifestyle, but again, back to your everyday rich, maybe that's not what you want.
That
Mhm.
makes you happy.
Yeah. We've mentioned your everyday rich, and part of the theme about your everyday rich is to talk about what everyone's everyday rich is,
Yeah.
because what your everyday rich is different than what mine and Steph and Jen's is. So what's your everyday rich in the future look like for you, Steph?
Yeah, I think for me is just definitely spending time with family and friends, doing experiences, doing those big trips. Like my family loves eating. So definitely trying those Michelin star restaurants.
Mhm.
And I think definitely not missing any big lifetime events. For sure is my everyday rich. Jon?
Yeah, I agree with that. For me, yeah, adding that plus for me, like part of my like you heard of the 6 human needs, right? By Tony Robbins, right? It was certainty, uncertainty, love, connection, growth, contribution, and what was the last one? Significance. So my top two were certainty, growth. Certainty, relationships, and growth contribution. So that's what I would
Mhm.
add. So is the growth and contribution part, right? So in some way, if I can help people like us, like talking like this, like
Mhm.
about financial education and stuff like that, that's something I would want to do going forward.
Yeah,
That'd
I
be a big
mean,
one.
that's amazing. It's like you don't hear these kind of I think conversations a lot, because it's scary to talk about it. B, I mean, it's not very sexy to talk about it. But if this happens more often in living rooms outside of this and yours, Jon, like you can have some really thoughtful conversations, because all these things can lead to so many other ideas and stuff. But like, well, why do you think Disney's actually a good investment right now? Or why do you think real estate in this market or that strategy is good right now?
Mhm.
And why don't you think it is? Or, hey, Jon, tell me more about bonds.
Yeah.
Like, so no, it's great, because I think people should be asking themselves, what everyday rich they want to live, and then
How do we get there?
build that. Because when it comes down to it, you need to be able to build that, right? Like, no offense, I mean, working a 9 to 5 can bring you some sort of joy, but if you ultimately want to build those to get to eating out, traveling, like you said, Steph, and Jon, for you, like what relations are helping back or whatever, or supporting Steph doing all that, right? We need that money piece, right?
True.
And so that's why we want to bring on people like you guys, so that you could share your journey, because there's obviously something working that's helping you guys get there,
Mhm.
right? We're not always we can't always see it right away, but if we give it enough time, we keep focused on that, we're gonna get there.
Yeah.
People just won't notice. Only you will. So from real estate standpoint, are you working on anything now, Jon and Steph?
Yeah, so we are still making the garage in our triplex at Welland still.
Yeah, Niagara. Yeah, so
Okay.
we have a conversion project there that we
Yeah.
bought last year in 2022. So that's coming to a close. So looking forward to that.
Okay.
But that's it for now. Yeah, and then we're still working on our student. Yeah, we still have the student rental and single family in St. Catharines.
Okay, cool. That's awesome. Yeah, so I guess some context, Jon and Steph have 3 properties, and those 3 properties in 25 years, 20 years, like maybe we'll be able to ask you in 25 years, right? Be like, so do you regret buying those?
All the headaches that you've had.
All the headaches.
Oh man, yeah, all the bitching and complaining.
yeah. And then you have a beer and go to sleep, and you wake up, you're like, oh, okay, it's okay.
Yeah.
That's okay. All right, so I want to try this kind of fun segment here. I'm gonna call it the Crazy Rich Asians and the EEAAO moment. So
What was EEAO?
EEAAO is
What does that mean?
everything, everywhere, all at once.
All
All right, so just a homage to obviously some of the Oscar award-winning Asian themed movies. So Jon, have you ever hugged your parents?
Man, that's a funny one, man. I think it only our wedding night. That's it. I swear to God. I don't even think. I think it's wedding.
My God.
Okay, so
I
you
can't
have.
remember.
Okay.
How about you? Did you ever?
My parents are very affectionate, so yes.
Shoot.
My dad asks like for a hug almost every time I see him.
Aw.
Even though I refused it to press his buttons.
How about your mom though?
My mom, same thing. I would hug her though, just because she's my mom. But my dad, I like to push his buttons a little bit, so I don't. But I end up doing it.
It's so weird, right? How about you guys? I'm just curious.
Yeah. No. I'm
not
saying
enough?
probably my wedding.
The longest time. Okay, so for the wedding, like I obviously had to dance with my mom, and I've never danced with my mom before, and I have a video of it and I have pictures. I'm just like holding my mom, and I'm just like, I wonder if this is more awkward from my mom than it is for me.
Probably.
But I had a good time because it was just, we were just joking around. Like, I've never shared this with anyone, but it was like, actually I shared it with you, but it was just me pointing out things to like the audience of saying like just funny stuff, like commenting on what people are wearing or what they're thinking, and all that stuff, and just trying to get her to laugh. But I have hugged my parents. We try more often now. It's still kind of weird. Just, I mean, from context, like Chinese culture, you do not show affection. It is so weird.
I don't know what it is. Why? Do you know why?
I don't know.
I don't know, Steph. You guys are the anti-Asian.
Yeah. Seriously.
I have no idea how that works. So
I think it's because my dad and his siblings actually went to university in Canada. Like they went to U of T. So I think that might like that.
This is a Western influence.
Like when they were at university. Yeah. My grandmother, like, really embraced it, loves hockey, loves wrestling.
Oh, wow.
Basketball. So growing up, we're pretty, like, I don't know, quote unquote, westernized. I don't know. Yeah.
Integrated.
Yeah.
A little bit more about the white portion of the banana.
Pretty much.
All right. Okay. So, well, I guess Jon, I think we already know the answer for both of this, but Jon, have you ever heard your parents say "I love you"?
I predict. Yeah. Oh man. I think my dad only because I got in trouble and he needed to make me feel better. I got in trouble. So I never told you the story actually. This is like as a kid, I got in trouble a lot. So he said it once, like, "Hey, we love you," blah blah blah. But like, other than that, never. Never.
Yeah,
never.
Same.
It's
never.
Never.
I've never, even in Chinese, never heard it. Never.
Never.
Heard it. It's more taboo than money. Yeah. Okay. All right, Steph.
Steph, your parents say "I love you"?
My dad would say it at least once a week to me. My mom, not so much, but my dad is very affectionate.
I'm waiting for Steph to pull out her like Mission Impossible mask right now. And, what the?
Non-Asian here.
It's like a blonde hair comes up like, surprise.
Shoot, man.
All right, cool. Okay, Steph. Dim sum or Ace buffets?
Dim sum.
Okay.
For me, I think dim sum.
Oh, interesting.
Yeah.
Okay.
Like, what do you mean? Like, what do you enjoy more, right?
If you had to pick, because Steph, you mentioned eating, right?
Yes.
Spending time with your family, friends, and eating. And we're talking offline. You guys had a nice dinner with your parents and stuff, right? Relatives. So
I think all you can eat for me.
I think just dim sum, just because it's like the environment and you're able to spend time longer.
You lose your hearing.
You do lose your hearing, but
Yeah.
There's no 2-hour limit, like all you can eat.
You lose your voice and you lose your hearing.
Yeah. Okay, cool. Okay, for both of you, instant noodles for breakfast, yay or nay?
yay.
Nay. I'm a health nerd, I guess, in a way.
John, have you been to Hong Kong? Have you been to Hong Kong before?
No, I haven't. I want to go.
That'll change your mind about
That's
instant
exactly what you'll be eating.
Yeah.
for
Really, yeah?
breakfast.
noodles. Okay,
I like
cool.
my oatmeal.
Here, why don't you ask the
So
last
good.
one? Why don't you ask the last one?
What are the last two?
This is the last one.
Oh, Korean barbecue or hot pot?
Korean barbecue for me. You?
Hot pot. Just because I feel like hot pot might have more vegetables.
Yeah, I agree. I agree.
You feel like crap more on Korean barbecue, though, right?
Yeah,
Like,
that's
Yeah.
the only downside.
Yeah.
That's the only
Too
reason.
Too much meat. Too much red
Yeah.
meat.
Yeah.
Yep. 2 minutes on the
Good
lips,
oil.
2 weeks on the hips. Nice. All right, cool. I guess if we wrap it all up in terms of like from a money perspective, if you had the foresight about fixed rates versus variable rates, because I think it's important, right? Because you're in real estate, we're in real estate. A lot of people listening might be thinking of real estate or whatever. Would you go with variable rates again, long term, or would you do fixed, and why?
Obviously, everyone would say the most common answer would be, "Oh man, I wish I did fixed," right? But
Yeah.
I think with real estate though, because it gives you that like the variable piece does give you flexibility if you wanted to sell, right? You're not going to be paying like 5-digit fees if you wanted to sell, so it does give you that flexibility.
Yeah,
Of course, I would love to take the fixed if I look back, right? Like,
yeah, fair
I
enough.
think I would still go like future going forward, still variable. Like,
Mhm.
I
Okay.
would-
Yeah. Okay, cool. Like, let's share some context here. So we're talking about mortgage rates. So in real estate, you sign in Canada, there are rates for essentially your interest charges for your loan.
Mhm.
Variable meaning that it fluctuates with what the Canadian government prime rate, right? And depending on that, your bank will give you a discount or not a discount. So it fluctuates with what the government interest rate changes. Fixed rate is you set a fixed number, and that's what you pay for that term. So
It's a contract.
it's like a contract. Yeah. Historically, variable has come out better, I would say, if you look at trends. But again, historically, no one really remembers what happens in the 80s, the early 80s, where it was 15%.
Yeah, but most studies have it's based on not real estate investing, but based on like if you were to sign fixed or variable over for a primary mortgage. I think most studies will say variable over the past 25 years.
Oh, yeah. Okay.
It's still better. Like, you know what I mean? Like you even going through the high periods of time. If you have a 25-year mortgage, you go through the variable rate, the ups and the downs over the 25 years, you're still on top.
Yeah. And I think it depends. The context, that's part matters too, right? If it's your primary residence, maybe fix is okay, right? It depends on the person's risk tolerance, right?
Yeah.
It goes back to what lets you sleep at night.
Yeah.
Because if your primary objective is to cut as many expenses out and be able to drive down that cost for yourself, then yeah, variable might be the answer. But if you want, like any business, you want to be able to fix your operating costs and stuff like that and know, like, okay, every month I'm just going to pay this. I don't have to worry about this fluctuation.
Yep.
So,
Yeah,
cool. All right.
Yeah.
What do you guys do?
It's funny. So for one property, which is our rent to own property, we signed fixed because we didn't know any better.
Yeah. It was our very first property. We were looking at
the lowest rate
possible to make numbers more attractive.
Yeah.
And obviously at that time, we didn't have the understanding about like what that could mean for us from a penalty standpoint, especially the type of investment, right?
Yeah.
So the rent to own is you are allowing someone to sign a contract for you in the future to buy it off of you. So the tenant moves in and they'll buy the property off of you down the road at a set price.
Yep.
And us not knowing that and realizing, oh, well, we're only going to own this for a few years. Like,
yeah.
Strategically, it didn't make sense because we were actually looking at a pretty hefty penalty.
Yeah, no idea what we were thinking.
Yeah,
So we signed like a 5-year fix, knowing that we were going to sell it in 3.
Yeah.
I don't know. See,
It's
like,
so stupid.
These are the stupid mistakes that you make, right? Your first investment property.
Yeah.
Why would I do that anyways?
Yeah.
We did anyways.
Yeah.
So then we were going to like, oh, we signed it already. Nothing you can do. And we're like, oh, well, we're going to have to pay this mortgage
Yeah,
penalty.
we're just going to have to eat it, take an L.
But then we lucked out.
Yeah.
And the tenant didn't.
Unable to close, which
close.
we're still trying to find a way for this tenant to basically, close down the road if the opportunity presents it, because that's the whole point of rent to own, is to put a home for someone that is looking to essentially buy a home, right, for their family.
But now it's also worked in our favor.
Yeah, it's worked in our favor
because we signed a fix and not a
Mhm.
variable.
Yeah, so sometimes dumb luck just happens, right?
Yeah.
Or mistake.
Yeah, by mistake.
It was a mistake.
But we were ready to
at that
eat that cost. So, yeah, if we were to share with people, like sometimes you think you can make the best guess and assumptions, right?
Yeah.
And be like, hey, you know what? I'm gonna go to dim sum at 11 o'clock. It shouldn't be busy, but when you get there, it's like packed for some reason.
Yeah.
Sometimes it works out, sometimes it doesn't. So it's just a matter of making the best guess for you. So,
yeah. Sometimes we don't talk about it, or you don't see in social media enough, is luck. Luck plays a big part of the journey. Huge. Like I'll admit, like we started a couple years ago in real estate. We of course done well, but that's a lot of it was luck too, right? Like it wasn't. Yeah.
There's always going to be two sides of that camp from a luck perspective. Or someone's going to say luck is a combination of preparation and good timing.
Yep.
Yeah.
Right. And other people would be like, well, yeah, I mean, I got lucky. But I think how you approach it will really kind of drive how you move forward and view things. I think it's the whole, like, do you see it as David Goggins or like Mel Robbins kind of approach?
Yeah,
right. So, but you're right. I mean, there's always an element of luck to anything.
Always,
so, because you can never control a lot of these macro environments.
Can't, yeah.
So, like,
and you can't predict them either.
Like, could you have predicted SVB bank, like this SVB banking collapse? No. But so everyone's thinking like, oh, this is dumb luck that they pat themselves on the back. I never invest in banks, but like, well, you never would have. So you never would have predicted this. So.
And I think a key lesson from that book, Jay, on psychology, was Morgan. He says, yeah, a lot of luck plays into it, right? Like, but how he positions himself is like to ride out these ebbs and flows, right? Those cycles, right? If you're okay with, in either scenario, right?
Yeah, absolutely.
Yeah.
All right, guys. So one takeaway we wanted for our audience, for every guest, was in respect to like living your everyday rich. Is there something that you could tell people listening that have not started their investment journey? What would you tell them?
Steph?
Jon.
YOLO. No, just kidding. Diamond hands, right? No,
Good answer.
I think it's interesting. Good first, understand your own risk tolerance, right? There's 3 parts to it. You understand your risk tolerance, your time horizon, and how much active and passive you want to be involved with, right? So, for example, Steph's situation, her time horizon is long, right? She wants to be passive. So, and what was the other piece? And your risk tolerance is more conservative, right? So that's why we went with like Wealthsimple, right? Index funds. So understanding your parameters is number one, and don't fall into the whole like, if you see another comparison is the worst, right? Is the biggest enemy. So don't follow anyone else besides maybe Warren Buffett. But yeah.
I think also is why you're investing, like your goal. What is your goal, right? Like, do you need money in the next, I don't know, a year?
That's why time horizon is important.
A year or so, and you need to take it out for something, or is it really just to build wealth? I think the goal and why is definitely a really big factor in the investment equation that Jon was talking about.
Yeah. All right. Sure. Cool. Nice. Good answers. But we appreciate you coming on and sharing your journey, because I think a lot of people will find a lot of value from hearing your story and connecting with, well, Steph, maybe not so much with connecting with your anti-Asian upbringing of hugging and affection and talking about money, but hey, you know what?
Live the Asian full house.
Yeah, the Asian full house. Yeah. But But for everyone listening out there, we only ask one thing: pay the fee, rate us, give us a comment. So if you found value from this conversation, from this living room dialogue, and you want to hear more, then leave us a comment. Let us know. Was there something you wish you heard, or something that I guess you found relatable and could, basically said, holy shit, that was a really good point. Or, it was nice hearing that as well. So let us know, rate us so that we can keep sharing our conversations with other people. And then hopefully this becomes a movement, Financial literacy and these conversations need to happen more.
And Jon and Steph, anybody want to reach out to you guys? What's the best way to do that?
What's your Instagram handle?
Yeah, so Instagram, DM me. I'm Stephanie Miss Yu.
And Jonathan Wong Investor on Instagram.
All right, awesome. Cool. All right. We'll put that in the show notes so that they can find you and creep you out on social media.
And our dog, follow her too. What is it there?
Oh my God, the multi-poo life of Leia.
Follow her as well.
For investing tips.
Yeah.
This is a trend with Dinks. So sorry. Dinks is dual income, no kids.
Dual income, no
have
kids.
A lot of
dual income, no kids with dog.
With dog.
Yeah.
We'll create a new thing. Dinky. All right, cool. All right, awesome, guys. Thanks very much for jumping on here.
Thanks, guys.
Thank you.
All right.
Everyday Rich podcast is presented solely for general informational, educational, and entertainment purposes. Any such information or other material should not be construed as legal, tax, investment, financial, or other advice. It is not intended as a substitute for the advice of a qualified professional.